With the election fever cooling across 4 states, attention is now shifting back to a critical economic concern. Buzz around a possible hike in petrol and diesel rates is growing louder, especially as global crude oil prices continue to soar amid escalating tensions in the Middle East. Although the government has repeatedly denied any immediate plans for a price increase, questions are certainly mounting over how long the current price freeze can realistically continue. Now, crude oil, which was trading near $70 a barrel before the Iran conflict intensified, has since surged beyond $100 and at one point even touched $126. Now, this sharp spike has significantly increased pressure on state-run oil marketing companies, which have been absorbing the rising costs to keep retail fuel prices unchanged, a move that is now translating into mounting financial losses. A recent PTI report citing government sources indicated that a price hike in petrol and diesel cannot be ruled out. Meanwhile, state-owned fuel retailers have already increased prices of commercial LPG, industrial diesel, 5 kg LPG cylinders and jet fuel for international airlines, aligning them with the rising input costs. Interestingly, despite the sustained surge in crude oil prices, domestic LPG cylinder rates have remained untouched so far. However, the 19 kg commercial LPG cylinders recently witnessed a sharp increase of Rs 993, indicating that fuel prices corrections may already be underway in certain segments. Now, as pressure on India's fuel pricing strategy intensifies, the International Monetary Fund has stepped into the debate with a clear message: let market forces decide fuel prices. The IMF has urged India to gradually allow domestic fuel prices to reflect the international market realities. Now, according to the global financial body, artificially keeping prices low may not be sustainable for much longer. In fact, as per reports, speaking at the National Council of Applied Economic Research, IMF's Director for Asia Pacific, Krishna Srinivasan, said, and I quote, "The government has cut excise taxes on oil. They provide some fertilizer subsidies. This can continue for some time, not much more in terms of fiscal space. At some point in time, you have to allow price signals to start to flow, and that's something which is true for India." In fact, he further noted that higher fuel prices can help curb demand during periods of supply constraints and suggested that government should instead focus on targeted subsidies for vulnerable sections of the society. The government, however, seems unconvinced by IMF's concerns. Countering the assessment, RBI Deputy Governor Poonam Gupta underscored India's comparatively strong fiscal position, highlighting projections that the country's gross debt is expected to decline from 83.4% of the GDP in 2026 to 77.7% in 2031. She attributed this improving outlook to disciplined fiscal management, sustained consolidation efforts and robust economic growth, all of which she said have enhanced India's ability to withstand external shocks. But why is it that the International Monetary Fund wants prices to rise? Let's understand that. The IMF's stance is rooted in economic fundamentals. It believes that allowing fuel prices to rise is essential for balancing global supply and demand. Now, the key concern is that when major economies shield consumers from rising fuel costs through subsidies for price caps, global demand remains artificially elevated instead of naturally cooling down. Now, this sustained demand can worsen supply shortages in already strained energy markets and also keep crude oil prices higher for longer periods. Now, with global oil prices remaining volatile and fiscal pressures mounting, India faces a complex policy challenge. Now, continuing price suppression may offer short-term relief, but it could also strain public finances and distort the market dynamics. What are your thoughts on this video? Do let us know in the comments section below.
If you like this video, then like, share and subscribe to ET Now.